Welcome to this week's market drama. We'll begin with the S&P 500, which was up 1.4% for the week. It is now up 5.4% for the year. The big news is that it crossed the index level of 5,000. Those are arbitrary numbers, shouldn't matter. But when it comes to the psyche, when it comes to broader media coverage, I'm sure there's going to be magazine covers on it, and that does attract more investors in, right? It's also worth noting that the S&P 500 is now up 40.5% from its October 12, 2022 low. So we have come a very long way. When we look at what's driving it right now, we talked about it every week, which is the economy didn't see a recession despite the Federal Reserve raising interest rates a lot. Inflation is coming down, which gives us an indication that the Federal Reserve might actually start lowering interest rates at some point this year. The market loves to hear that. And it's also supported by earnings. Earnings are the long-term driver of stocks, right? So when we look at this earnings season, 67% of companies have already reported for the S&P 500. And 75% of these companies have beat their earnings per share estimates, which is slightly below the 5-year average of 77% of companies beating. Basically, they set a mark and they make sure that they could beat it. But we look at how many of them are beating it is right around what we usually see, 75% now, 77% is the average. It's also the second consecutive quarter that if this trend continues, we've seen positive earnings growth, right? We had a couple quarters in a row where we had negative earnings per share growth. So earnings are holding up. So investors look at that, look at the economy, look at inflation coming down and say, hey, why wouldn't the market continue to go up higher? That's the story so far. So the bottom line here when it comes to the consumer is that it's not yet tapped out, right? It has a pretty strong balance sheet, not as strong as it used to be in prior quarters, but it's still fairly strong. And I mentioned this because there's been a number of headlines around credit card debt and how it's ballooned out of control. I wouldn't read too much into those headlines, and shout out to Sam Rowe, who's written on this topic and brought it to my attention, is that when you look at credit card, not as just the absolute number in dollars, but as a percentage of disposable income, right now it's around 5.5%. Which is pretty much in line for where it has been the last 12 years. What has happened is that, income has also gone up, inflation has gone up. So therefore credit card, absolute number of dollars in credit cards has also gone up. But just to give you for context for what bad looks like for that number is in 2007, the consumer was too levered up and that credit card as a percentage of disposable income was closer to 8%, right? So we're nowhere near that. Okay, that's it for this week. Next week, we have January CPI numbers, give us an indication of inflation. We also have retail sales, which will give us a barometer for how the consumer is holding up. That's it for this week. Stay tuned for next week.